In this video, you'll be learning about this topic. When I'm listening to some of your other interviews, and the one thing that really sticks out to me that I think is such an important conversation for people to really understand is some of your comments around inflation, risk premiums, the impact that this has as you think about it from a business owner, and the hurdle rate that you've got to achieve. Talk to us in depth. Don't hold anything back on this particular topic, and teach people how you're thinking about things from an economic calculation standpoint as the CEO, the founder of a billion-dollar company.
Okay. Look, I think we start with this premise of your CEO, your job is to preserve shareholder value, preserve wealth. That it's the same challenge you'd have if you ran a family office and you were responsible for the wealth of the family. The question is, how do I preserve the value of my individual treasury or corporate treasury over time? So let's say I have $1 million. So in a hard money environment, if the currency is utterly deflationary, if the Federal Reserve or the central bank was going to print no more currency for the next decade, then I've got $1 million. Next year, I'll have $1 million. If I'm looking at the value of my cash, my $1 million, I can presumably have it sit in an account, and a decade from now, I'll still have $1 million of purchasing power because the currency is not being devalued. Now, if the goods and services in the economy are growing at 2% a year and the currency is flat, then a fixed amount of currency is going to be chasing after an increasing amount of goods and services. In that particular case, the currency is going to appreciate in value, and so the prices are going to fall. And so that's a good thing. It means that all I have to do is just sit on the money and wait, and the economy will be larger. The value of my treasury will accrete. If the banks print 2% more currency and the economy grows 2%, then you've got a net equivalence. The value of my treasury won't accrete, but it won't dilute, right? So in theory, if you think about the good old days of the gold standard, if gold has a stock to flow of 50, then it's inflating at 2% a year. And traditionally, the economy of the world and the economy of most large countries grows about 2% a year. And so it's kind of ironic that the 2% gold inflation is offset by the 2% economic expansion, and you have a stable gold dollar or a stable amount of value, and over time, that kind of makes sense. So what happens when I start to increase the currency? If I increase the currency 5% a year, well, now will the economy grow 5% a year? If the economy grows 0% a year, the currency increases 5% a year, then I've got more money chasing after a fixed amount of products. Therefore, the price of the products have to keep going up. And they're going to go up 5%. The stuff that you're wanting to get, the scarce stuff, something that you can manufacture infinite supply of, like a copy of a Picasso, a digital copy of a Picasso, that's not going to inflate. But the actual Picasso is going to inflate to the extent that everybody in the society wants that one painting. And of course, what you see is that as you start to print more money, inflation is not distributed equally. There's not really a single inflation number. There's a vector of inflation. In fact, I can come up with a set of products. You really need linear algebra. You need a vector math to describe this. One set of products that are information rich with no variable cost, like a digital copy of a Picasso, and there used to be 1 million digital copies, and now there are 1 billion digital copies. And even if I print a gazillion % inflated currency, the billionth digital copy of the Picasso is not going to be any more expensive. In fact, what's going to happen with a certain bucket of goods that are high inflation, high information content is they're just going to get cheaper over time. They're deflationary products. And what's a good example of that? Digital music, digital video, digital photos, digital services running on networks that have a fixed price, a fixed cost. Once you've actually paid to deploy Wi-Fi and LTE networks, and once you built the routers, and once you've built the electrical power plants, and once you've run all the fiber optic cable, that's all the fixed cost. The variable cost of deploying a Netflix movie to 1 million people is the cost of electricity. And deploying the Netflix movie to 1 billion people is the variable amount of electricity. Right. So in essence, that's got to be like 0.1% variable cost. There is no variable cost. There's no energy content in the product. That is to say, the perversity, right, is that it's all energy. It's 0.1% of the value of the product is energy. I'm just shipping electrons, and energy is fairly cheap. So with things like that, they're deflationary because the fixed cost is a sunk cost, which is amortized across all of the products. You've got one iPhone, you've got one television, you've got one fiber optic cable to your house. And therefore, everything I can push to the iPhone and everything I can push down the fiber optic cable, I can deliver at the variable cost of electricity, which starts to look like a product with a 99.9% gross margin. Okay, so what's interesting? Well, in the history of the world, if you roll the clock back 50 years, we didn't have any products with a 99.9% gross margin. 99% gross margin products are a product of modern digital networks. So Apple created a mobile network. They dematerialized everything you could hold in your hand. And that means that your VCR and your CDs and your cameras and your Polaroid photos, right? And your phones and your tape recorders, and your weather, your atlas and your maps and little books and reminders and yellow Post-it notes. All these things had energy content in them, and they had a variable cost. I mean, traditionally, variable costs run anywhere from 40 to 60% of the value of the product. You have to produce it for 60% of the retail value, and you sell it down a retail distribution channel. And eventually, the true margin is like 7%, or Walmart 3%, whatever it is, and the other 97% gets eaten up. That's what the world looked like, and then what happened with the mobile wave or the last decade is Apple dematerialized all of the mobile products or all the handheld products and converted them from 40 to 6% variable cost to 1% variable cost. And Apple then accrued $1 trillion of value because it was that network. It's crystallization of sorts. You're collapsing from a high energy state to a lower energy state. And when you crystallize, what energy gets given off, right? And that energy took the form of wealth created for the Apple shareholders. Google did the same thing. They pretty much dematerialized every library and every piece of every book and every piece of information and every video and every home video and every VHS and all the music on the earth. And it collapsed into Google and YouTube and the like. And as it collapsed, right? This is a real library behind me. Okay, I'm sitting in a library of books, and it's $100,000 worth of books in this room. Worthless, because you go get yourself a $500 iPad, and you can have the entire 100,000 books. And by the way, the 100,000 books on the iPad is more valuable because they'll read themselves to you, and you can resize the font. I'll walk past like this perfect book, and it's a beautiful book, and I open it up, and it's classic, and it's like in a really small font, and I'm like, can't I pinch and zoom the book And then I go on a trip and I'm like, I really want to take that book or those 10 books. They're really heavy. I leave, the books have mass, the books are static, the books have to be shelved. Someone can take the book. I might lose the book. Google took every library on earth, collapsed it, just like Apple's got their iBooks, right? They collapse these things. The variable cost goes to zero. So you have all these things that Google touched that became deflationary. Everything that Facebook touched became deflationary. Everything that Amazon touched. The part that Amazon eliminated, by the way, was like the 40% of the retail supply chain that was a storefront. Well, 40% of everything anybody wanted to buy collapsed into a mobile app on an iPhone or collapsed into a website. 40% of the cost of the energy cost and it's conservation of mass and energy, right? That's thermodynamics. Well, every product you buy, it either has mass, right? Like the books have mass, or it has energy. I had to deliver the comic book to the newsstand, and I had to I was a paper boy, right, Preston? I was a paper boy growing up, and sometimes I fall into that. Like, what about the paper boy? And then I realize there's probably no paper boys left on the planet. That's not a job anymore. Like, who would deliver a paper? If I deliver a paper, you've got the mass, and that's the paper. Paper is made of titanium, by the way. Titanium dioxide is the primary element in paper. It's no pacifier. I got my start in business studying titanium. It's heavy. I remember carrying stacks of papers around. It's like 100 pounds worth of information it had to move through the supply chain. And then there's the energy, mass and energy. The energy was like me with my red wagon hauling 100 pounds of papers on a Sunday morning through the neighborhood in the freezing snow. And you got to, and at some point, my angelic mother getting up at 5 a.m. to drive the family station wagon, keeping the heat on while I haul papers through the neighborhood. I delivered them, by the way, on Wright-Patterson Air Force Base, where I grew up. I know every single street because I had to get up and deliver a 2-pound paper to every house across the entire military base when it was like 20 below zero. So mass and energy in the news business. I expended the energy. I hauled the mass around. It was quite visceral. It was expensive. It's so expensive, by the way, that no newspaper could afford to hire an adult to do it. Hence, 12-year-old to 18-year-old high school kids hauling newspapers around on their backs. That was the world that we used to live in. And of course, now it's kind of laughable. No one's going to haul that stuff. Yeah, you probably couldn't get a 12-year-old to get up during. I remember a blizzard. It got to it was 60 below zero, Preston. And we're trying to figure out how to deliver newspapers on a Sunday morning at 5 a.m. The wind is blowing.
And on the Air Force Base, you had a lot of traffic to contend with at 5 a.m., unlike other places.
Mass and energy. So Facebook, Google, Amazon, Apple, they dematerialize the mass and the energy from the products. All the products are information and electricity. And that explains why they're trillion-dollar companies. And that explains why inflation as a metric doesn't work. It might, it's a 20th century idea, and it might have almost, but I'm not sure it ever worked, but it wasn't hideously misleading until the last decade. And the last decade, we got to the point where half of everything you're consuming is pure information with no variable cost.
So when you say it's been a hideous metric, you're specifically talking about CPI, right? You're saying CPI is just not something that can actually measure what in the world's going on right now.
I'd say it's a metaphysical metric. It has no relation to reality. It's been defined almost almost specifically cherry picked to define in such a way that there will never be any inflation. And so the first irony is we've decided that inflation is a bad thing. And the second decision is we've decided that inflation equals CPI. And the third, irony is we can't find any inflation. But of course, in order to really understand store of value, in order to get to the bottom of investment rationale and make rational investment decisions, you have to first go to first principles. And what I find is 95% of macroeconomists and analysts and the traditional investment community, they rely upon metaphysical abstractions that they learned early in their career or that are repeated to them over and over again by mainstream media. And because they just repeat these metaphysical abstractions long enough, they kind of convince themselves that there's some veracity to them. And there isn't any veracity to them. But the difference, and this takes me back to MIT. At MIT, they taught you to think for yourself. You're an engineer. If you're trying to solve a problem, you're expected to think for yourself. Like, for example, the first class I walked into, it was a class in material science. The professor walked out to all the freshmen. It was our first week at MIT. He said, "This is a tile from the space shuttle. It burned off the space shuttle on reentry. Nobody at NASA knows why it burned off. They're not sure what to do about it, but they're afraid the space shuttle is going to blow up if they don't actually solve the problem. Why do you think it burned off? And what do you think the solution is?" And he looks at it. These are 18-year-old freshmen that showed up to school. And you can see everybody's looking at each other like, is there some reading that we missed before this lecture? And then they're thinking, I didn't read the answer to the question. And then there's this horrifying realization that a guy with a PhD with 20 years experience just asked you a question that nobody on earth knows the answer to. And he expects you to think for yourself and reason from first principles and solve the problem. That's the scientific way. And there's not a lot of science and there's not a lot of engineering in the modern macroeconomic landscape or with mainstream media. They just repeat tropes over and over again as though they're meaningful, and they're not.
I mean, you couldn't provide a better example for what we're seeing right now from an economic standpoint. It's almost like we're seeing parts of this shuttle, call it the economic machine that we're looking at, literally falling apart right in front of our eyes. And you still have many academics with PhDs going on CNBC and talking about, well, we just don't have any inflation and these types of things. So this is what I would frame it for you. How would you, Michael Saylor, define inflation today? Because you still have to do economic calculation as a business owner. How are you looking at inflation, and how are you saying, well, I think if inflation's this, that's my hurdle rate plus whatever risk premium? Talk us through how you would define it, considering CPI is so broke.
I think the way you define inflation is the rate of price appreciation in a basket of goods, services, or assets that you desire to acquire in the future. So, if you live with your parents in the basement of their house, and you don't need a house, and you don't aspire to a yacht, a plane, a beachfront property, if you don't intend to ever pay for electricity or utilities, if you borrow your dad's car, and if your mom cooks for you, and you sleep in the basement, you're going to define inflation as the cost of beer, good weed, Netflix, YouTube, I don't know, Tinder, like whatever you're going to do when you take girls out on a date, right? That's the cost. That's inflation. that market basket of things that you're going to have to pay for out of your pocket is inflation to you. If your father kicks you out of the basement and says it's time for you to grow up and get your own place and get your own car, you're going to define inflation as the cost of a car, the cost of an apartment, the cost of food, the cost of the electrical utilities, right? And, and anything else that's discretionary. And you have to embrace food and energy and apartment. If you actually aspire to get a PhD or be a medical doctor or whatever that might be, you're going to have to include in your inflation definition the cost of college education, medical school, et cetera, and higher education. If you imagine having perfect health, then inflation won't include medical care. If you imagine that you might actually need, maybe you need your teeth fixed. By the way, like Preston, I grew up on an Air Force base. Dentistry and healthcare were free. I was a dependent. My father was an NCO. I needed to go to the hospital. I went to the hospital on the base. Everything was free. Didn't really think about it. Then we went through this period where there's health insurance, and you just went in network and everything got paid for. I have noticed in the past 10 years, Preston, that none of the doctors I go to and none of the dentists I go to accept any of my health insurance. And I have really good health insurance. I have like world-class health insurance, but every place I go, it's like if I want good health care or good dentistry, they ask me to give them a credit card, and I end up actually with a very large bill, from all of these doctors, because they don't accept that insurance. So the insurance only pays for half. And so if you actually want the best medical care, it could be 20 in perfect health. If you want your teeth fixed or you want, whatever, you need the best medical care, then you got to throw dentistry and doctors not in your insurance network into the inflation calculation. If you get to the point where you're 60 and you've got some medical conditions, you're going to throw all of those more expensive treatments. Once I dislocated my shoulder, and it was a silly accident. Like I tripped on a wet floor while I had my hands full, and I landed, and it hurt more than anything in my entire life. So I went to the hospital. They reset the shoulder after a while. Then I went to an orthopedist, and the guy looks at me and he goes, I said, well, so how long will it take before I get this cast off or this sling off? Because I'd Googled, it was like a week or something. He goes, oh no, we need to operate on you. I said, huh? He goes, well, you're a perfect candidate, to have, some shoulder surgery, we should just fix it perfectly. It's like $50,000. He goes, you're a perfect candidate for this. I was a perfect candidate because I could afford to pay the $50,000.
Yeah.
Or by the way, and I said, no, I'll let it heal. It healed just fine. I'm not going to, it was my left shoulder. I'm not pitching, as a baseball pitcher. I don't really need the $50,000 operation, the 6-month recovery and the potential infection and the rest. But, the best medical care was going to be extended to me because I could afford to pay the $50,000. So if you're defining inflation, do you want really good medical care? Do you want your teeth fixed? Do you want a ceramic crown, right? Do you want, silver in those fillings? Do you want it same day? What quality of medical care do you want? The inflation rate's going to go up, I guarantee you. Do you want to go to Harvard or MIT? They're not going up at 2% a year. I know they're going up 7% a year, 8% a year. Now, there's a market basket of products that if you sleep in your parents' basement that will be deflationary. You can probably live fairly cheap. Uber is not going to go up that much. There's another market basket. If you're going to live on your own, it's going to go up faster. It's probably, X percent, 3, 4, 5%. The Chapwood index starts to indicate, what if you actually aspired to own your own house? Well, if you wanted to own your own house, housing prices have been going up for 4, 5, 6%, 7% a year sometimes. So that inflation rate would look different because that's an asset. Of course, CPI doesn't include assets. Now the question is, where do you want to live? The inflation rate of real estate in my hometown, Fairborn, Ohio, is not nearly as high as the inflation rate of real estate in Miami Beach or the Hamptons or New York City, Manhattan. It turns out that there's a differential. Now, why is there a differential? Because the assets are scarcer, or the thing that causes price to go up is it's scarce and it's desirable, right? And so you can't really come up with one price of real estate inflation in the United States, because there's a lot of land in Kansas, and if what you aspire to is 5 acres of property and a nice house in Kansas, that's not going to inflate at the same rate as aspiring to a 4,000 square foot apartment in New York City.
You can just look at the prices in Jackson Hole. And I know the first time I went out there and looked at the prices for real estate, I said, why is everything so expensive? Well, then once you realize that the land out there is super scarce because you have all these state parks and everything surrounding it that have created this island of land that's available, you can see why the prices are sky high, and because it's scarce. Now, when you're talking about real estate and you're talking about the inflation associated with it, let's go into equities. Let's go into fixed income and talk about how this quote unquote inflation is impacting securities.
Yeah. So if I want to live on my own as a single person, I want to rent an apartment, and my market basket is food and energy and a nice apartment and a car. If I want to have a family and own my own home, my market basket evolves to be a lot more family health care, higher education for my kids, more land for everybody to play behind the house, a house, real estate, property taxes, more utilities, appliances, and maybe family vacations, right? And the like. So that's a different market basket for the middle class family. If I want to be wealthy, then my market basket that I aspire to is a very nice, an elegant estate in the country, or beachfront property in a hip, cool town like Miami Beach or Southampton or Malibu, right? That becomes a different market basket. And of course, a home in LA and Hollywood Hills, that's a different inflation rate. If I want to be really rich, what do the wealthy aspire to? Well, they're aspiring to own Apple stock. They want to own stock, bonds, commercial real estate. You want to own things that produce income. So what's the cost to buy a basket of shares in Apple that produce $1 million a year in dividends? Well, that cost doubled in 12 weeks. 100% inflation in 12 weeks this year. The dividend didn't double. The price of the share doubled. Therefore, hyperinflation in a market basket of stocks. In fact, the S&P, if we look at the S&P index, one of the most interesting metrics is the number of hours that you have to work in order to buy a share in the S&P. Right? And we see that chart, and that's doubled, right? That's shooting up. What do the wealthy want? Well, they want to buy real estate in Manhattan or Tokyo or London. They want to buy dividend producing or income producing assets. They either want to buy rent producing real estate, or they want bonds that will produce a good coupon, or they want stocks that either will produce dividends or will buy back shares so that they're inherently deflationary, or they will grow, right? Or they want scarce. They want to buy Picassos. They want art. Or by the way, or they want to buy franchises. I would like to buy, the Jets. I would like to buy a football team. I would like to buy a baseball team. That's what really wealthy people wish to do. Or they wish to buy jets, or they wish to buy yachts, right? None of these things are in the CPI basket. I mean, the presumption, of course, is that politicians have assumed that no one wants to be wealthy. Let me say that again. Politicians have assumed no one wants to be wealthy. I guess if you assume no one wants to be wealthy, and if you track the things that the wealthy people don't aspire to, then you won't find inflation, and then you won't have a problem. As long as we agree that no one can be wealthy, right? You're never going to get there.
Don't you think that that's a little bit more out of convenience for the fiscal spending that aggressively has become more and more aggressive, that it complements their ability to continue to spend and obligate dollars and try to push some of those dollars into their regions that they're elected? And so by using CPI and pushing it lower and lower, they can just reduce that interest payment and obligate even more funds of taxpayer dollars.
I think as long as you define the metric as CPI, and as long as you leave out every scarce asset, every financial asset, food and energy, then you can lock on to a basket of goods that are inherently deflationary. You will never get inflation. Therefore, there will be no check on your ability to keep printing money. And when you print money, if you call it accommodation, we're providing $120 billion a month of accommodation to make the markets fluid, to keep them functioning, right? Then you don't have to say we're devaluing the money by $120 billion a month. And I think it's a convenient thing. At the point that we redefine the market basket as assets, well, we would have immediate inflation, and there would be immediate check and balance on the ability of any central bank or any bank to devalue the currency. And so I don't think anybody wants to have a check on their abilities. So this has been adopted as a metric. The mainstream media promulgates the metric, and then I know why. I know why someone running a central bank would want to focus on the metric. I just think it's irrational for macroeconomic analysts and investors to fixate on the metric. And so, for example, if you're defining a macroeconomic model that has CPI as an input, you're just engaging in metaphysical musing that is increasingly disconnected from reality. Let's come back to this inflation definition. So I think that you can define a bunch of buckets, and the definition of inflation comes down to what's your aspiration. If your aspiration is to be a billionaire, then the definition of inflation is the rate at which scarce assets that are going to continue to appreciate are going up in price, right? So what's the best investment idea? Bitcoin. How fast is it going up in price? 200% this year. We have hyperinflation in pure property, in pure liquid money. Hyperinflation. We have inflation in scarce and desirable assets. Houses in the Hamptons are up 50% in 16 weeks, right? The price of a house in the Hamptons. What is that? Well, when you buy a house in the Hamptons, you're buying a scarce piece of property on an elite real estate network. When you buy a Bitcoin, you're buying a scarce piece of property on a global liquid monetary network. Okay, which is better? Well, clearly Bitcoin is better because Bitcoin is liquid, global, fungible. I can take it anywhere on earth. And by the way, there's no property tax on it. And I don't have to worry about New York State taxing my property away from me, right? So given a choice between investing 20 million in Bitcoin or 20 million in Hamptons real estate, clearly the rational thing is buy 20 million worth of Bitcoin. But if you're a New Yorker and you've decided you need to get outside of Manhattan, well, all the wealthy New Yorkers, they all go to the Hamptons. It's a social network / real estate network. It's scarce. Ergo, prices go up by 50% in 3 months, and the transaction volume goes up by 50%. And they're turning over the entire real estate business is up 100% year over year. The real estate agents are doing great. Is there inflation? If your aspiration is to live an elegant life of affluence in the New York area, then you have hyperinflation, right? In that real estate market. So, and of course they do, right? Go to a wealthy New Yorker and say, well, there's no CPI inflation, nothing to be concerned about here. You just got to decide what you want to put in the basket. I think that when you work your way through it, you conclude you can look at it as like 5 buckets, right? There's the affluent bucket, and you're seeing 20 on average across all assets, right? It's like that 20 to 24% M2 monetary supply expansion rate. So you could say that the inflation rate for just a broad basket of assets is like 20% or so this year, or 24%. That's why the stock market's at an all-time high, because people that have liquid monetary energy, they want to buy those assets, and they're all bidding against assets that are scarce, or they're reasonably scarce. Not totally scarce, by the way. The reason that those assets aren't going up as fast as Bitcoin, the reason that gold is outperforming maybe the S&P is because the S&P they're producing more securities, they're producing more convertible debt and more equity, and so it's not quite as scarce. It's harder to produce the gold, but of course it's really hard to produce the Bitcoin. So what you've got is everybody surging to acquire more assets. The asset supply isn't expanding as fast as the money supply is expanding. Ergo, the price is going up. That is inflation of assets, or asset inflation. I would just call it cost of capital.
So let's talk about that a little bit more, because a lot of the people in our audience are people that are trying to perform economic calculation. They're trying to value a business. And I love this example of M2 that you're talking about, using it in a frame of reference as your risk-free rate. And then talk to us about that a little bit, and then also talk to us about whatever the risk premium would be on top of this quote unquote risk-free rate.
Okay. Yeah. So our inflation is just a vector. So you've got a market basket of stuff that's deflationary, it's not inflating. You've got another market basket of stuff that's probably going up 3 to 5%. You've got another market basket of stuff that's going up 8%. But if you really want the best measure, if your goal is wealth preservation, if your desire is to be wealthy or to stay wealthy, wealth preservation, you're either pursuing wealth or you wish to preserve wealth, you wish to preserve shareholder value. Your best surrogate is cost of capital, which is closest to the rate of the broad money supply expansion, which was 24% this year, which as we look out is going to be probably between 10 and 15% a year, every year for the next 5 years. And that's based upon the Federal Reserve policy, the EU central bank policy. You've had Lynn Alden estimate that she thought it was 13%, but a lot of the estimates are optimistic and politically correct. Nobody can stand up on television and they can't estimate, well, it was 24% this year, it'll stay 20% next year, and then 20%, and then 30%. Because that's like not forecasting a V-shaped recovery. In March, everybody forecast a V-shaped recovery. You kind of have to, because otherwise you're kind of Cassandra, Debbie Downer, politically incorrect. No one could forecast an L-shaped recovery. That is Main Street's going down and not coming back up again. Have you noticed that you haven't seen anybody talk about the L-shaped recovery on television? Well, here's the joke. We got a V-shaped recovery in financial assets. We got an L-shaped recovery in Main Street operations in real business, but they didn't call it L-shaped. They called it K-shaped recovery. So they came up with just a nice, pleasant phrase, right? K-shaped recovery, because it doesn't sound as horrifying as L-shaped recovery or no recovery, right? So I think the forecast as you look out is, I would guess 15%. Like my best guess is 15%. I've seen people say it'll be 15, then it'll be 20, then it'll be 25. It could get worse. That would be a hyperinflation scenario, or it could be better. It's like if we start to run less deficit, but that'll require fiscal austerity. And that never worked it didn't work in Greece. It hasn't worked in Southern Europe. It hasn't, it didn't work in Italy. We haven't seen it work anywhere in particular. So I wouldn't expect it.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.